Arlan Suderman from INTL FCStone is our corn and soybean market analyst this week with a longer-term view of possible price movements. Arlan and I were part of Central Valley Ag's grain winter meetings across Nebraska last week. The topics there included concerns about trade as well as a look at future demand for U.S. corn and soybeans. To be clear, we talked a week before the U.S. Department of Ag's supply and demand estimates, which were released Thursday. In New York, our discussion included oil prices, Brazil's production potential, and how Arlan's presentations at the events seem to cheer up attendees. Arlan, I think you were kind of the ray of hope at these meetings. You walk around with some farmers and they say, I think Arlan is bullish. Would you say that's accurate?
I'm very careful about using the word bullish around farmers because they instantly think $6, $7 corn, and by no means. I am friendly to the markets from the standpoint that from my study of the markets and involvement of the funds, I found that when they are bullish the commodity sector, I'll use the term there, and they are believers in the commodity sector, that does impact the price, the cash price on the farm. On corn, it's 50 cents or so above what you would expect it to be relative to the fundamentals. When they're bullish, when they're bearish a commodity sector, it's 50 cents to the negative side. And I see this changing tide right now. It's too early to fully confirm, it's just the early signs of it. But it looks like the funds are starting to fall in love with the commodities. The grains have been the lagger, but they're cautiously now coming into the grains too now, thinking maybe it's time to close the gap. One of the triggers of that was the break in the dollar we've seen over the last month, which has accelerated to the downside, and are starting to realize just how much more attractive that makes our commodities. They're starting to come in and buy. Fundamentally, we can point to some things too. We still have plenty of grain around, certainly, but there is some sign that maybe the worst is behind us. And so the funds like hearing that, and that piques their interest.
What are your thoughts long term? Maybe some demand potential out into the future?
Well, the good news is the U.S. economy is taking off, and the global economy is taking off. We're seeing some good health in the European economy finally. And when Europe's healthy, that tends to help make China healthy. And they're the largest importer of commodities, raw commodities. So as the economies get stronger, demand for commodities strengthens. Demand for the commodities is strong, the ags is strong. It's just we've been oversupplying with a couple of really big crop years on both sides of the equator. If we go back toward a more normal production type of a cycle, all of a sudden that demand starts to peak, starts to use up those supplies once again, and it just helps to firm prices.
Now that's good news perhaps for U.S. producers, but Brazil is also producing a lot of corn and beans, and they believe they can significantly scale up production. Do you consider Brazil to be a threat in this?
Very much. Brazil is someone who has to be respected. The amount of territory and brushland and pasture they can clear for cropland, not touching the rainforest, is equivalent to the Great Plains stretching from Canada down to the Texas Gulf. That is not being developed to a great extent because of the corruption in government, their economic problems, and a lot of that, and I see that being around for quite some time. So long term they are a legitimate concern, but for now the demand is there if we can just get back to more reasonable yields on both sides of the equator.
There have been several questions about NAFTA at these meetings, but you think that TPP could actually be more critical to U.S. farmers. Why?
I really do. When you look at the participants in the TPP, and the buyers and the sellers, the producers that are in there, I think for the most part corn and soybeans are probably going to fare pretty well. Wheat and the meat market, particularly beef, I think we could really see some pain there if we're not a part of TPP. And I noticed that President Trump, in the absence of having anybody on his staff being approved by the Senate yet to negotiate bilateral agreements, is starting to talk about maybe getting back into TPP since they're moving forward with it without us. And that's probably a good sign, and we probably need to be involved to protect those markets.
What is your short-term and long-term outlook for wheat? It's an interesting commodity in this part of the world right now.
Well, it is, and it's particularly of concern to corn farmers because it's that huge supply of feed wheat that we have in the world that's kind of a lid on the corn market, and including here in the United States. Big supplies, I see reduced acres this year, and with normal yields we'll continue to ratchet down the supply of wheat. Most of the surplus wheat that we have elsewhere in the world is primarily in Russia, where they have constricting infrastructure at this point, and in China where they're trying to keep it all for themselves, so to speak. Here in the United States, the big concern, of course, is with the drought and a winter kill. We won't know the full effects of the winter kill until it breaks dormancy, but we do know that the winter wheat ratings in Kansas and Oklahoma, those key wheat production states, have absolutely plummeted. And it does suggest we've got some serious problems, and the forecasts are that those areas will stay dry right on through the heading period. So we could be taking care of some of those surplus supplies.
Let's end with a very practical look here at oil markets and what you think might be a good opportunity, or when might be a good opportunity to lock in some fuel prices.
Yeah, crude oil is a leading indicator for the funds toward the commodities as well. When we look at the energy market, supplies here in the United States are more toward typical levels now. We worked out the surplus even with the big increase in shale oil production. The funds have built record ownership, speculative ownership in it. This is a market that's past due for a correction, just like the stock market, but yet the brakes keep being bought. People ask me, when will there be a break so I can book my diesel fuel needs? You would expect there will be one. We've seen a little consolidation now. There's a little bit of nervousness, but so far every break's been bought. So I really can't guarantee there'll be one like the stock market over the past year.